All right, Kenzo John Ag here with Market Acme, and I need you to lock in for the next several minutes because what I'm about to break down for you is happening in real time. And by Wednesday of this week, we will have confirmation of something that institutional players have been quietly positioning for over the past several weeks. This is not speculation. This is not theory. This is not another recycled headline from mainstream financial media designed to fill airtime. This is about a specific convergence of central bank signals, currency positioning data, and economic indicators that are all pointing in the same direction. And the window for acting on this information is measured in hours, not weeks. I'm talking about the Federal Reserve minutes being released on Wednesday, the advanced GDP figures that will show whether the U.S. exceptionalism narrative is still intact, the diverging paths of central banks around the world, and the thin holiday trading that is masking positioning moves by institutional players who understand exactly what's coming. The dollar index is holding at 97.12 right now, and most retail investors think that stability means everything is fine. What they don't understand is that this stability is artificial, maintained by holiday liquidity conditions that are about to end, and when normal trading volume returns, the real price discovery will begin. Let me give you the specific data points that are driving this analysis because I want you to understand that everything I'm about to share is sourced from official releases, institutional commentary, and market data that anyone can access, but almost no one is interpreting correctly. On Tuesday, February 18th, 2026, the dollar held gains in thin trading as markets awaited signals about the potential timing of rate cuts by the Federal Reserve. Trading was thin with many markets in Asia closed for the Lunar New Year holiday and following the President's Day holiday in the United States. The dollar index was little changed at 97.12 after a 0.2% gain in the previous session. The euro fell to 118.43. Sterling weakened to 136.16, and the yen strengthened slightly to 153.28 per dollar. On the surface, this looks like a quiet day in currency markets. Nothing to see here, just normal fluctuations during a holiday period. But here's what mainstream financial media is not telling you, and this is critical. Thin trading conditions are exactly when institutional players make their positioning moves because the low volume allows them to build positions without moving prices significantly. When you see the dollar holding steady on low volume, it doesn't mean everything is stable. It means the big money is quietly positioning before the catalyst hits. And what's the catalyst? The Federal Open Market Committee releases minutes from its January meeting on Wednesday. This document will reveal the internal debate among Fed officials about the timing and pace of rate cuts. Money market traders are currently pricing in 62 basis points of easing for the rest of this year, implying 2 quarter-point cuts and about a 50% chance of a third. The next cut is expected in June, with markets assigning an 80% probability of a 25 basis point reduction. But here's where it gets interesting. Christina Clifton, senior currency strategist at Commonwealth Bank of Australia, said something in her institutional commentary that most retail investors completely missed. She said, and I quote, "We judge that the most important driver of the dollar through 2026 will be the narrative of U.S. exceptionalism." Read that again. The most important driver of the dollar is not interest rates, not inflation, not trade balances, not any of the fundamental factors that economics textbooks say should determine currency values. The most important driver is a narrative, a story, a belief system that may or may not be grounded in reality. This is an institutional analyst telling you explicitly that the dollar's value is dependent on market participants continuing to believe that the United States is exceptional, that American assets are the safest and most productive in the world, that there is no alternative to dollar dominance. The moment that narrative cracks, the moment the data stops supporting the story, the dollar loses its foundation. And here's what I want you to understand about narratives. They persist until they don't. They hold until they break. And when they break suddenly and violently because everyone rushes for the exit at the same time. The U.S. exceptionalism narrative has been the dominant theme in global markets for the past 15 years. It has justified dollar strength, U.S. equity outperformance, and massive capital flows into American assets. But the data is starting to crack that narrative, and the Fed minutes on Wednesday may accelerate the process. Let me show you why the U.S. exceptionalism narrative is more fragile than most people realize, because this is where the institutional signals become impossible to ignore. The data released on Friday showed that U.S. consumer prices increased less than expected in January. Annual price growth slowed more sharply than forecast, prompting investors to scale back their more hawkish Federal Reserve rate expectations. This sounds like good news for the economy, and mainstream media certainly presented it that way. Inflation is cooling. The Fed can cut rates. Soft landing achieved. State Street is one of the largest custodian banks in the world, with over $40 trillion in assets under custody and administration. When their Tokyo branch manager tells you that real money investors are selling dollars and buying yen, that's not speculation. That's institutional positioning data. These are pension funds, sovereign wealth funds, and insurance companies, the largest and most sophisticated investors in the world, and they are actively reducing their dollar exposure. Why are they doing this? Because they see the same thing I'm showing you. The U.S. exceptionalism narrative is cracking. The Fed is trapped between sticky inflation and an economy that needs lower rates. The interest rate differential that supported the dollar is narrowing, and the structural fiscal problems of the United States, $36 trillion in debt, $2 trillion annual deficits, are becoming impossible to ignore. Now let me introduce you to a framework that will help you understand why central bank divergence is so critical to the dollar's trajectory, because this is where the real institutional analysis happens. Right now, we have multiple major central banks moving in different directions. The Federal Reserve is expected to cut rates starting in June. The Bank of England's chief economist, Hugh Pill, just stated that the BOE's job in bringing inflation under control is not yet complete, stressing that monetary policy must stay restrictive. The Reserve Bank of Australia's minutes showed they were uncertain whether further hikes would be needed, highlighting that inflation had been above target for 3 years. The Bank of Japan is expected to continue raising rates as inflation persists. Do you see the pattern? The Fed is moving toward cuts, while other major central banks are either holding or potentially hiking. This creates what currency traders call divergence, and divergence is one of the most powerful forces in foreign exchange markets. When the Fed cuts rates and other central banks don't, the interest rate differential favors foreign currencies over the dollar. Institutional investors can borrow in lower-yielding dollars and invest in higher-yielding pound sterling, Australian dollars, or even Japanese yen. This carry trade puts selling pressure on the dollar and buying pressure on the foreign currencies. But it's not just about the rates themselves. It's about the signal that divergence sends about relative economic conditions. If the Fed needs to cut rates to support the U.S. economy while other central banks can maintain restrictive policy, what does that tell you about the U.S. exceptionalism narrative? It tells you that the United States might not be as exceptional as markets have been pricing in. The advanced GDP figures coming later this week will provide the next data point on this question. If U.S. GDP growth disappoints, if the economy is slowing more than expected, the exceptionalism narrative takes another hit. If GDP surprises to the upside, the narrative gets a temporary reprieve. But temporary is the key word because the structural factors undermining dollar strength are not going away regardless of any single data point. Let me show you what's happening in Japan because this illustrates the dynamics I'm describing in real time. Official figures released on Monday showed Japan's economy barely grew last quarter, eking out an annualized 0.2% expansion. This was worse than expected, and on the surface, it looks like bad news for the yen. A weak economy should mean a weak currency. That's the textbook logic. But look at what actually happened. The yen strengthened to 153.28 per dollar, despite the weak GDP data. Why? Because money is flowing into Japan's stock market, and investors buying Japanese stocks need to buy yen first, because the Bank of Japan is expected to continue raising rates even as other central banks cut. Because real money investors at firms like State Street are reducing their dollar overweight and buying yen. Japan's currency has remained about 4% weaker against the dollar since fiscal dove Sanai Takaichi became prime minister last year. But the tide is turning. Investments continue to flow into Japan, and institutional investors are positioning for yen strength despite the weak economic data. This is counterintuitive if you only follow mainstream financial news, but it makes perfect sense if you understand that currency markets are forward-looking and driven by capital flows, not just economic fundamentals. The smart money is betting that Japan's combination of rising rates, strong stock market, and relative fiscal discipline will attract capital flows that strengthen the yen even as the U.S. exceptionalism narrative fades. Now let me talk about what's happening with the Australian dollar, because this is another piece of the puzzle that reveals the real dynamics at play. The Australian dollar weakened slightly to $0.7064 after minutes from the Reserve Bank of Australia's February meeting showed the board was uncertain whether further hikes would be needed. The minutes revealed that members were worried that the risks to the RBA's inflation and employment mandates had shifted materially. Here's what's significant about this. The RBA concluded that inflation would stay stubbornly high if it had not hiked interest rates as it did. They're not rushing to cut like the Fed. They're maintaining restrictive policy because inflation remains above target. They've been dealing with above-target inflation for 3 years, and they're not willing to declare victory prematurely. This policy stance supports the Australian dollar against the US dollar. While the Fed is pricing in 62 basis points of cuts this year, the RBA is still debating whether more hikes might be necessary. That divergence creates a natural bid for the Aussie dollar and a natural offer for the US dollar. And remember what I mentioned earlier about commodity currencies. The Australian dollar is a commodity currency closely tied to the prices of iron ore, coal, and other raw materials that Australia exports. When commodity prices are stable or rising and the interest rate differential favors Australia over the United States, the AUD-USD pair tends to appreciate. This is another signal that the dollar's strength is being challenged from multiple directions simultaneously. Now let me bring this all together and explain why the Fed minutes on Wednesday are so critical, because this is where the timeline becomes actionable. The minutes will reveal the internal debate among Fed officials about when and how fast to cut rates. If the minutes show a more dovish tone than expected, with officials expressing concern about economic weakness or confidence that inflation is under control, the market will bring forward rate cut expectations and the dollar will weaken. If the minutes show a more hawkish tone, with officials emphasizing persistent inflation concerns or the need for patience, the market might push back rate cut expectations and the dollar could strengthen temporarily. But here's what I want you to understand. Both scenarios ultimately lead to dollar weakness over the medium term. If the Fed is dovish, the dollar weakens because rate cuts are coming faster. If the Fed is hawkish, the dollar might strengthen briefly. But the economic data will eventually force their hand, and when they're forced to cut rates into economic weakness rather than cutting preemptively, the market reaction will be much more severe. The Fed is trapped. They have $36 trillion in debt that becomes more expensive to service with every basis point of interest rates. They have an economy that is showing signs of cooling despite the strong labor market headlines. They have inflation that is declining but still above target with sticky services components. And they have a market that is pricing in cuts regardless of what they say, because the market understands the fiscal mathematics better than the Fed officials will ever admit publicly. This is why the U.S. exceptionalism narrative is the most important driver of the dollar in 2026. It's not about the fundamentals anymore. The fundamentals are clearly pointing toward dollar weakness. It's about whether market participants continue to believe the story despite the evidence. And narratives can persist for a long time, but when they break hard. Let me give you a historical parallel that illustrates exactly where we are in this cycle, because the patterns repeat with remarkable consistency. In 2000 and 2001, the U.S. exceptionalism narrative was built around the technology sector and the dot-com boom. American technology companies were going to dominate the global economy. The U.S. was the center of innovation. Capital flowed into American assets at unprecedented rates. The dollar index peaked at around 120 in 2001. Then the narrative cracked. The dot-com bubble burst. The technology stocks that had justified the exceptionalism narrative lost 80% or 90% of their value, and the dollar began a multi-year decline that would see it fall approximately 40% by 2008. Investors who were concentrated in U.S. assets without hedges experienced devastating purchasing power destruction. Today's exceptionalism narrative is built on similar foundations. American technology companies, particularly those related to artificial intelligence, have driven U.S. equity market outperformance. Capital has flowed into American assets seeking exposure to these companies. The dollar has remained strong despite massive fiscal imbalances because investors believe the U.S. is exceptional. But what happens when the AI narrative cracks? What happens when the technology concentration that has driven returns becomes a source of systemic risk? Deutsche Bank is already warning that AI risks in U.S. equities are undermining the dollar's safe haven status. This is a major European institution telling its clients that the same technology sector that justified dollar strength might now be the source of its weakness. The pattern is remarkably similar. A narrative built on technology exceptionalism, massive capital flows into U.S. assets, a dollar that defies fundamental gravity, and then a sudden repricing when the narrative breaks. I'm not saying the AI bubble will burst tomorrow. I'm not predicting any specific timeline for the technology correction. What I'm saying is that the foundation of dollar strength is a narrative, and narratives are inherently fragile. The Fed minutes on Wednesday, the GDP data later this week, the ongoing central bank divergence, all of these factors are stress testing the narrative in real time. Now, let me talk about what you should be doing with this information, because understanding the problem is only valuable if you take action. The first thing you need to understand is that thin trading conditions like we're seeing now are not a reason to wait, they're a reason to act. Institutional players use low volume periods to build positions precisely because they don't want to move prices against themselves. By the time normal volume returns and the moves become visible, the opportunity is past. The second thing you need to understand is that the Fed minutes on Wednesday will be parsed word by institutional analysts looking for any hint of the Fed's true thinking. If you wait for the headlines to tell you what the minutes mean, you're already too late. The algorithms will have already traded the news and the move will be in progress. The third thing you need to understand is that central bank divergence is a multi-month theme, not a single-day trade. The Fed cutting while other central banks hold or hike creates sustained pressure on the dollar that will play out over quarters, not days. This means you have time to position, but you shouldn't wait for perfect clarity, because clarity will only come after the move has happened. So what are the specific actions you should be taking right now? Let me walk you through the institutional positioning framework. First, you need to reduce your concentration in dollar-denominated financial assets. If you're a US-based investor with 100% of your portfolio in US stocks, US bonds, and US cash, you are completely exposed to dollar weakness. A 20% decline in the dollar means a 20% decline in your international purchasing power, even if the nominal value of your portfolio stays the same. The action here is to diversify into assets that benefit from dollar weakness or are denominated in other currencies. Physical gold and silver are the most obvious choices because they are inversely correlated with the dollar. When the dollar weakens, gold and silver prices rise in dollar terms. This is not speculation. It's a mathematical relationship that has held for decades. Gold is currently trading around $2,150 per ounce. In a scenario where the dollar weakens 20% to 30% over the next 2 to 3 years, as it did during the 2001 to 2008 period, gold could easily reach $4,000 to $5,000 per ounce. Silver, which currently trades around $30, could reach $50 to $75. The asymmetry is heavily in your favor. Your downside is limited to current prices, which have strong historical support, but your upside is multiple times current levels if the dollar weakness scenario plays out. Second, you should consider international equity exposure, particularly in markets where central banks are maintaining or raising rates. Japanese equities are seeing strong institutional inflows despite the weak GDP data. Australian equities benefit from the RBA's relatively hawkish stance. European equities are cheap relative to US equities and benefit from euro strength if the dollar weakens. The key is to think about your portfolio in terms of currency exposure, not just asset class exposure. A Japanese stock fund gives you exposure to both Japanese corporate earnings and the yen. An Australian equity ETF gives you exposure to Australian corporate earnings and the Australian dollar. This dual exposure means you benefit both from the equity returns and from any currency appreciation if the dollar weakens. Third, you need to reduce duration risk in your fixed income allocation. The Fed minutes might reveal a more hawkish stance than expected, which could push long-term yields higher temporarily. Even if the Fed is ultimately dovish, the inflation data shows sticky services components that could keep yields elevated. Long-duration bonds are the most vulnerable assets in an environment of inflation, uncertainty, and rate volatility. The action here is to rotate into shorter duration instruments or move out of fixed income entirely and into real assets. Treasury inflation-protected securities provide some hedge against inflation, but they still carry interest rate risk. The safest approach in this environment is short duration or no duration at all. Fourth, you should pay attention to cryptocurrencies as a potential beneficiary of dollar weakness, but with appropriate position sizing. Bitcoin is currently trading around $68,981. Ethereum is around $1,919. These assets have shown some correlation with dollar weakness and serve as an alternative store of value for investors who distrust fiat currencies. However, cryptocurrencies are extremely volatile and carry risks that gold and silver do not. I would not recommend more than 5% to 10% of your portfolio in cryptocurrencies, and only if you can tolerate significant short-term volatility. Physical gold and silver should be your primary hedge against dollar weakness, with cryptocurrencies as a speculative kicker for those with higher risk tolerance. Now let me address something that I know is going through some of your minds. You might be thinking that this analysis is too bearish, that the dollar has faced challenges before and survived, that the US exceptionalism narrative is based on real advantages that won't disappear overnight. All of those things are partially true. The US does have real advantages: the deepest capital markets in the world, the most liquid currency, the strongest military, the most innovative technology sector. These advantages are real, and they're not going away tomorrow. But here's what you need to understand. Currency values are determined at the margin, not by absolute advantages. The dollar can be the best currency in the world and still lose 30% of its value if the market reprices expectations. The US can maintain its advantages and still see capital outflows if the interest rate differential shifts. The exceptionalism narrative can be partially true and still crack if the data stops supporting it. This is not about predicting the end of the dollar or the collapse of American power. This is about recognizing that we are at an inflection point where the factors that have supported dollar strength are reversing, and positioning your portfolio accordingly. The Fed is moving toward rate cuts. Other central banks are not. Real money investors are reducing their dollar overweight. The fiscal mathematics of $36 trillion in debt are unsustainable. Central bank divergence is putting sustained pressure on the greenback, and the exceptionalism narrative that has supported the dollar is dependent on continued belief, not just fundamentals. The Fed minutes on Wednesday will provide the next data point. The GDP figures later this week will provide another. The core PCE inflation data coming soon will provide another. Each of these releases has the potential to either support or undermine the narrative, and the weight of evidence is increasingly on the side of dollar weakness. Here's what I want you to do right now. First, take an honest inventory of your dollar exposure. Add up everything you own that is denominated in US dollars, including cash, stocks, bonds, retirement accounts, and real estate, with dollar-denominated mortgages. Calculate what percentage of your total net worth that represents. If it's above 80%, you have concentration risk that needs to be addressed. Second, start building a position in physical gold and silver. If you don't own any precious metals, start with 5% to 10% of your liquid net worth. If you already own some, consider increasing to 15% to 20% given the current environment. Physical metal is the key, not paper claims, not ETFs, not unallocated accounts. You want metal in your possession or in fully allocated segregated storage. Third, consider international diversification through currency-hedged or currency-exposed international equity funds. Look at Japanese equities, Australian equities, and European equities as alternatives to US-only equity exposure. Fourth, reduce duration in your fixed income holdings. Move from long-term bonds to short-term instruments or exit fixed income entirely if you can tolerate the portfolio volatility. Fifth, subscribe to this channel and turn on notifications because I'm going to be covering the Fed minutes when they're released on Wednesday, breaking down what they mean in real time and providing actionable analysis that you will not find in mainstream financial media. The institutional players are already positioned. The thin trading conditions have allowed them to build their positions without moving prices. When normal volume returns and the Fed minutes provide a catalyst, the moves will begin. The question is whether you're going to be positioned alongside the smart money or whether you're going to be caught on the wrong side of the trade, holding dollar-denominated assets while the exceptionalism narrative cracks. Here's what I want you to answer in the comments, because this helps me understand where this community stands and what topics to prioritize in future videos. Are you currently diversified outside of dollar-denominated assets? Do you own any physical gold or silver? And what is your biggest concern about the dollar's trajectory over the next 12 to 18 months? Let me know, because the feedback from this community shapes the analysis I provide. The dollar is holding at 97.12 in thin trading. The Fed minutes drop on Wednesday. GDP data comes later this week. Central banks around the world are diverging. Institutional investors are reducing their dollar overweight. And the exceptionalism narrative that has supported dollar strength is dependent on continued belief, not just fundamentals. These are not opinions. These are facts that you can verify from official sources. The only question is what you're going to do with this information. You can wait for the headlines to tell you what's happening after the move is already in progress. Or you can position now, while the opportunity still exists, and be ready when the catalyst hits. The choice is yours, but the clock is ticking, and Wednesday is coming fast. Share this video with anyone you know who has significant wealth in traditional dollar-based assets and hasn't thought about currency risk. The people who will be hurt most by this transition are the ones who assume the current system will continue indefinitely without questioning the narrative. This is Kenzo John Ag with Market Acme. I'll see you in the next video.